Candlestick charts. Traders and investors less commonly use candlestick charts because they are considered to be more complicated and cumbersome than bar charts. There are more than 150 candlestick signals and patterns, showing a level of complexity and sophistication that most traders do not consider worth learning. However, candlestick charts are gaining popularity as educational material on the topic is becoming increasingly available. Education is power. Candlestick charts are similar to the bar charts as they both display the complete trading range by showing the four important price values: open, high, low, and close. In trading, the candlestick chart displays the four important price values of a specific time frame: 1 minute, 5 minutes, 10 minutes, 30 minutes, hourly, daily, weekly, or monthly. The main difference between bar chart and candlestick chart is in the body of the chart. After drawing the vertical line and the horizontal dashes to connect the high with the low and the open with the close, just like the bar chart, a box is formed. The box is called the body of the candle. If the closing price is higher than the opening price, the color of the candle is green. If the closing price is lower than the opening price, the color of the candle is red. The vertical line appearing above the body is called upper shadow. The vertical line appearing below the body is called lower shadow. The body and the shadows form what we call candlestick charts, or simply candles. The size and the color of the body and the length of the shadows are very important information regarding the current market direction, possible market reversals, and the strength of future price movements. Candlestick charts can be used as a tool to benefit from reversal and continuation patterns during uptrends, known as bullish markets, as well as during downtrends, known as bearish markets. We will discuss in greater detail the importance of such information in following lessons.